Principles of Finance with Excel Modeling, Topic 2, Time Value of Money and Valuation. This topic also includes a bonus lecture, which is a brief introduction to VBA programming. A good reference for this material is the Benninga textbook, Chapter 2, Time Value of Money, and Chapter 7, Forecasting. And if you're interested, there's a little discussion of market efficiency in Chapter 14. In this topic, we're going to understand the time value of money, compute the value of lump sums, annuities, and perpetuities, compute enterprise and equity value using cash flow valuation models, and create a two-factor data table and use solver. And then lastly, the bonus lecture, creating VBA functions. So let's start by talking about the time value of money and valuation. The concept of time value money is the idea that a dollar tomorrow is worth less than a dollar today, because a dollar today could be invested and earn interest and be more valuable. So let's do a very simple example. Suppose IBM, the corporation, issues a bond that promises to pay the future value of a $100 lump sum. So that's going to be delivered to you in 1 year. How much would you be willing to pay today, and we call that the present value, for this bond? Well, it's obvious that an investor will not be willing to pay over $100 today for a promise of $100 next year. Suppose the risk-free interest rate, say the interest rate on Treasury bills, say a 1-year security issued by the U.S. government, that pays investors 2% interest. So in other words, if an investor gives the government $100, that investment earns 2%, and they will have $102 next year. This concept here is called the future value. So if I have a present value of $100, if I multiply that times 1 plus the interest rate to the n number of years, that'll tell me how much money I will have in a future value of n years. So $100 invested at 2% will have a future value of 102 next year. So we'll say that's the example of a treasury. So this treasury will pay you 102 next year, and to earn 2%, you should be willing to pay $100 today. Now let's go back to our IBM bond example. If the bond is going to pay $100 in 1 year, we could rearrange the future value of a lump sum payment, lump sum meaning a single payment formula, solve it for present value. So we can say that the present value, the amount I'd be willing to pay today, is the future value over 1 plus r to the n number of years. So if IBM promises to pay me $100 next year, the future value, and I want to earn a 2% interest, I will pay exactly $98.04 today. And if I do, I'll earn exactly 2%. And we could prove this calculation by using the calculation up here. If I do invest $98.04 today and earn 2% interest, I will have exactly $100 next year. So this is the rationale in which to justify paying at least $98.04 today for a promise of IBM of $100 next year. That'll guarantee me a rate of interest of 2%. However, I would not buy that IBM bond for $98.04. I would only buy a treasury that promises to pay me $100 next year. That's because, unlike treasuries, corporations are risky, right? Treasuries own printing presses. They can always print you your money. But in companies like IBM, there's some risk that they will not be able to pay you next year. So suppose with this IBM bond, you assess the risk of this bond and notice that other bonds that have similar risk are offering a 5% return. So you determine that for the riskiness of IBM, I want a 5% return. Therefore, $100, that future value, discounted at 5% for 1 year, is $95.24. If you pay $95.24, you will and get your $100 back next year, you will earn exactly 5% interest. So, solving our initial problem from this slide, how much did you pay for a promise of IBM of $100 in 1 year? Well, if you demand a 5% interest, or rate of return, you'll pay exactly $95.24 today. So this is the idea of the time value of money and concept of valuation. What would I pay today for a promise of a future cash flow? So let's go back to our formula. If the present value is equal to a future value over 1 plus R, all right, where N is the number of period of time in which you get the lump sum, and the future value is in which the future value is received, and R is the periodic interest rate. What rate of return will the investor earn if she buys that IBM bond for $96? So in other words, if I pay $96 for a $100 promise 1 year from now, I could solve this equation for R. Well, let's do that more generally. So I'm going to rewrite my equation. Present value equals future value times 1 over 1 plus R to the n. That's just another way of writing f future value over 1 plus R to the n. I can then divide both sides by the present value, multiply both sides by 1 plus R to the n, and I get this equation here. 1 plus R to the n equals future value over present value. And then I can solve that equation for R, basically taking both sides to the 1 over n power. And I can see that R, the periodic interest rate, is equal to the future value over present value raised to the 1 over n power minus 1. So back to our question. If you paid $96 today, present value, for a promise of $100 next year, I'll take 1 over my n of 1 and take 100 over 96 over 1 over 1 minus 1. That gives me a rate of return of 4.167%. Here's another question for you. What if this bond makes no payments until year 2? So IBM promises to pay you $100 2 years from now, but you want to earn a 5% rate of return per year based on the riskiness of the bond. Well, I can just plug in my equation and take my $100 over 1 plus R, which is my 5%, raised to the 2 power. So what I'd say is I'd pay $90.70 for a promise of $100 2 years from now. Or more generally, the present value of $100 2 years from now at 5% per year is 90.7%. Now, question, what if this payment from IBM wasn't a bond payment, it was a dividend payment? Would you pay more or would you pay less for that instrument? Well, I would probably pay less, because bond payments are made before stock payments. In other words, if a company is running out of money, it'll first must pay off its bondholders before it can make a dividend payment. So dividend payments are riskier. So I'd pay less, and how I do that is I decide what rate of return I would demand for that riskier payment and divide by 1 plus that interest rate to the n power. So let's do a few worksheets that use present value and future value. So we're going to go to the start file. And I have some data already plugged in. So my first function is going to calculate a present value. So if I have a future value of 100%, 1 year, at R percent, 5%, I can use my formula and say that 100, my future value, divided by 1 plus the interest rate, or discount rate, raised to the 1 power is 95.24. However, you could use Excel's PV function, equals PV. Open paren, and notice it's asking me right here for the rate, 5%, comma, number of periods, 1, comma. Now notice it says payment. Now whenever the functions in Excel ask for payment, this is a payment that's received multiple times. So I'm going to say 0, comma, future value of $100. So let's, and where it says type there, let's not worry about that for now. And whenever you see a function in there that has it in brackets, it's optional. Now let's talk about two things here. First of all, I'm going to click on that cell. I'm going to click on my function wizard here and look at my inputs here. My rate is 5%, 1 period. Now payments. Now notice it says payment is the payment made each period and cannot change over the life of the investment. So this is a payment that we paid, say, every year for a number of years. That's not what this IBM one payment bond is giving me. The future value is the single payment at the end of the bond, or end of the stream of cash flows. So also notice that if you put in a future value of 100, the answer turns out to be a negative value. That's because what the present value is telling you is I would pay $95 today to receive $100 next year. So the pay is putting some negative sign there. The idea I'd pay 95 to receive 100. If you wanted to change a sign to that, you can just put a negative sign in front of the present value, or put a negative sign in front of the the future value, and that would change it back to a positive. Let's do this problem the other way around. What if the present value is $95.24, future value is 100, n equals 1? What is your rate of return on that investment? Well, I could just take my future value divided by my present value, raise it to the 1 over n power, and subtract 1. That's my 5% rate of return. Or I can use Excel's rate function, in which I put the number of periods, comma, payment, remember that's 0, comma, present value, 95, future value, 100. Well, see, that's not working. So here's what we're going to do here. In order for the rate function to work, you need to do inflows and outflows. So what we're going to say is that the present value is we're going to pay $95 today and receive 100. What rate of return would you earn? And there's the 5%. Last one, we're going to do a future value. So we have in this problem, we have a present value of $95. We have a 1 year, and the interest rate or discount rate is 5%. How much is the future value? In other words, if you invest $95 for 1 year at 5%, how much will you have in the future? Well, I could use a formula, present value times 1 plus that discount rate or interest rate raised to the 1 power. However, I could also use a future value function equals FV. Let's put in the rate, comma, periods 1, comma, payment, let's go with 0. We're going to do payments in a little bit. And then we're going to say put in a present value of $100. And it's going to give me a negative $100 answer. If I wanted to change the sign of that, I could say I'm going to put in a future value, negative present value of $95. How much will I have in 1 year? And the answer would be 100. So these are using Excel formulas and also using Excel's built-in functions, PV, rate, and FV. So now what we're going to do is talk about annuities. Annuity is a series of equal cash flows. So for example, IBM promises to pay you not just $100 next year, but $100 per year starting in 1 year for a total of 5 payments. So the cash flows are going to be 100, 100, 100, 100, and 100. So we say that's a 5-year annuity of $100. And say you demand a 5% rate of return. So how we're going to solve that is we're going to use a spreadsheet solution and also use Excel's functions. So coming up here, we're going to use the present value function again. So we're going to say equals PV. Let's go ahead and put the discount rate in, 5%, or that interest rate, comma, n is 5 years, comma, payment. Now we're going to use the payment function because payment refers to multiple cash flows. So $100, and then we'll just close that off, and it'll give us a present value of $432. So if I paid $432 today, I'd earn exactly a 5% annual rate of return if I receive my 5 cash flows of $100. And if I want to make that a negative or positive, I can just make the cash flows negative, or I could just change the sign of the whole function right here. So let's actually also show what Excel's actually doing in that payment function. So here are the cash flows I've entered, 100, 100, 100, 100, 100. It's taking each cash flow and dividing it by 1 plus the discount rate. I'm going to put the 5%. I'm going to anchor that by putting dollar signs in front of E and 3. Raised to the n power. I'm not going to put dollar signs around that because I want that to move as I slide the formula down. So I'd pay $95 for the first payment, $90 for the second, $86 for the third, $82 for the fourth, and $78 for the fifth. I'm going to sum that out, equals sum. The present value of all 5 cash flows is $432.95, which is the value of my function here. So I'd pay $432 for a promise of $100 per year for 5 years if I wanted to earn a 5% return in total per year. And we'll do one other. Well, let's go back to our presentation here. Now, what if the annuity starts today and continues for 4 years? Well, if I had to value that, so in other words, what if the cash flows are year 0, 1, 2, 3, 4? Well, I believe I'd pay more for that cash flow, right? Because all of these cash flows are a little bit closer in time. They start today and not 1 year. So what you could do is simply change this to 0, 1, 2, 3, 4, and that will give the present value of the cash flows. And we could do that. So if those cash flows started in year 0, today, 1, 2, 3, 4, notice I'd pay $100 for a cash flow today. I'd pay $454. Now let's go back to the function, how I get the function to do that. So I'm going to click on the function. It's going to bring up this little argument box here. And here where it says type, notice it says type. Payment at the beginning of the period is 1, payment at the end of the period is 0 or omitted. So if you don't put anything, it assumes the first cash flow received at the end of the year. If you put a 1 in there, it assumes the cash flow was received today, the first one, and there's 454, and there's 454. So generally in finance, cash flows start at the end of the first period, but if you had a situation where the cash flow started today, you can just put in a 1 in the present value function, and it'll give you the present value of the 5-year annuity starting today. All right, back to the presentation. Let's talk about coupon bonds. Now, we talked about IBM bond, and we said it paid $100 next year, one payment. However, in general, bonds pay multiple payments. An annual coupon bond is a security in which an investor receives an annual coupon equal to the coupon rate times the bond's par or face amount. So we'll talk about par and face amount in a minute. At maturity, the investor also receives that face amount or par. So in other words, here's a bond that we're looking to value. Say that this IBM is going to invest in a 5-year, 4% annual coupon bond that has a face amount of $100 or par of $100. What that means, if I take my par times my annual coupon rate, say $100 times 0.04, that means I'm going to get a $4 payment per year for 5 years. So in other words, I got 4, 4, 4, 4, and there's $4. But the way annual coupon bonds work is you're going to get, in addition to those coupon payments, you're also going to get a payment of par. And that par is just that $100, and that's going to be added on to the last coupon payment. So the last payment is going to be $104. So we can use Excel's present value function to solve that. We can put in the PV and put the R of 5%, that's the discount rate, 5 years. Payment, let's put in $4. And future value, let's go ahead and put $100 in, and that gives me $95.67. Or we can use the spreadsheet we just used the last time, And instead of putting 100 for all the cash flows, we'll go ahead and put the 4, 4, 4, 4, and then par plus interest payment 104. Gives me the present value of each cash flow by taking the cash flow over 1 plus that discount rate. In this case, my discount rate is 4%. I'm sorry, in this case, the discount rate was 5%. I'm sorry, so let's talk about that for a minute. The annual discount rate, or I'm sorry, there's a mistake here. This should be an annual coupon rate of 4%. My R is really my annual discount rate. So let's make that change, that this should be the annual coupon rate is 4%. That annual coupon rate is simply used to calculate the cash flows. The annual discount rate is the interest rate to take the present value of those cash flows, and that gives me 95.67. All right, our last set of valuation formulas, we talked about the present value, future value of a lump sum. That's a single payment. And then we talked about the present value of annuities. I'm sorry, perpetuity, or annuities. Now we're going to talk about the present value of a perpetuity. Now, perpetuity is simply a cash flow that goes on forever. So the present value of a perpetuity is equal to the payment over R, the discount rate. So what is the payment? The payment is a cash flow that starts in year N and goes on forever. So if N is year 1, this is a cash flow that starts in year 1 and goes on forever. I'm going to simply divide that by the discount rate, and that'll tell me the present value in the period N minus 1. In other words, today, if this N is, right, if N is equal to 1, N minus 1 is equal to 0. So in that case, the present value of a cash flow received next year, and it goes on forever, discounted at rate R, gives me the value in year N minus 1, or present value in this case, value in year 0. So it looks like the example here. How much would you be willing to pay for an infinite annual payment of $100 starting in 1 year if you demand a 5% return? Well, I'll just put my cash flow received in year 1 over my discount rate, 5%. And that answer is simply $2,000. So in other words, it's $100 a year, and it goes on till infinity. So that's a perpetuity, or sometimes called a constant perpetuity because the cash flow doesn't grow. One other perpetuity we're going to talk about is present value. In this case, present value of a growth perpetuity, the G right there. A growth perpetuity is a cash flow that starts out at some payment, say $100, but then grows at some rate. The actual cash flow grows at some rate, say 2%. So that means if the cash flow is 100, the cash flow in year 2 is 102, and the cash flow in year 3 is 102, and keep growing it by 2% forever. It just so happens that the present value of a growth perpetuity is the cash flow received in the first year, that payment, over R minus G. In other words, the discount rate minus the infinite growth rate. So I'll take $100 over 5% minus 2%, so it's $100 over 3%, and I'd pay $3,333.33. Now, what if this cash flow started in year 5? Well, this is an interesting example. So if the periods are 0, 1, 2, 3, 4, 5, and you're going to get the cash flows or payment is going to be 0, 0, 0, 0, 0, and then eventually we're going to get $100, and then that $100 grows at 2% forever. Well, obviously I'm going to pay a little bit less than $3,000 because I have to wait 5 years for my cash flows. But we can go back to our formula that if I put in 100 over 0.05 minus 0.02, that gives me the value the period before the first cash flow. So in this case, if cash flow is in year 5, all right, let's erase this for a minute. If that first cash flow is in year 5, it's going to give me the value in year 4. So in other words, that $333 we just calculated is actually the value in year 4. The present value of that, I need to discount it back 4 more years, and that's what I'd pay for that annuity or perpetuity, that growth perpetuity specifically, that starts in year 5 and goes on forever. So let's go back to our whimsical. Now in our whimsical example, we forecasted in year 1 that the company would have dividends of $987,000 and has shares of $980,000 or 980,000 shares today. In other words, it's going to have dividends. If I take 987,000 of total dividends divided by 980,000 shares, it's going to pay $1.01 in dividends. The question is, how much would I pay for this company per share that has these dividends? So the first thing we're going to do is something called a dividend discount model. Now, the dividend discount model is a model which says that the value of any stock is the present value of all future cash flows. And this is a specific case of a more fundamental equation in finance, and that is the fundamental value of any financial instrument or security is the present value of all future cash flows discounted at a rate that reflects the risk of the cash flow. So we forecasted that this company is going to pay $100 or $1.01 per share next year. And then let's assume that that goes on forever, a no growth perpetuity. I'm going to apply my present value perpetuity formula of my cash flow over my discount rate, and I would pay $6.73 today. However, why wouldn't we expect that cash flow will grow, right? There's a certain inflation rate in the economy, and we might raise prices, and profits will go up every year, and the company's dividends will go up. So the present value of a growth perpetuity, if we believe it's going to pay a dividend of $1.01 next year, and those dividends grow at 2% forever, I can take my present value growth perpetuity, and I'd say, well, I'd pay $7.77 for that stock. Now, if the stock's actually trading for $10, I'd say, no way, I don't want to buy it. So this is the dividend discount model. The dividend discount model says the value of any stock is the present value of all future dividends, and the justification for this model is the dividend is the only direct regular payment that firms make to shareholders. However, there's one other valuation model that's actually more commonly used, and that is the free cash flow models. But let's talk about why people are dissatisfied with the dividend discount model. For one, many corporations pay no dividends, all right, and they've paid no dividends for, say, decades, and they may not be paying dividends again or in the future for a long time. So companies are not paying dividends, so how would I value that? Use the dividend discount model. Secondly, the dividend discount model doesn't account for capital gains, which may be driven by the firm's growth of assets or cash flow growth. So the model we're going to generally focus on is the free cash flow valuation model. How you do the free cash flow valuation model is the first thing is we're going to estimate enterprise or total firm cash flows. We're going to call those free cash flows of the firm that we discussed in the last topic. Remember, free cash flows of the firm are EBIT, earnings before interest and tax, times 1 minus the tax, add back depreciation, subtract CapEx, subtract changes in non-cash working capital. We'll then calculate the present value of all expected free cash flows of the firm. We'll call that the enterprise value. And we'll make sure the discount rate we use reflects the risk of the total firm's cash flows. And then lastly, we're going to say the fundamental stock price is the entire firm value, the enterprise value, minus the net debt divided by shares outstanding. And the advantage of this model is it applies for firms that pay no dividends. And also the justification, you can say, well, why would I pay this amount? Well, if some investor were to buy the firm, the entire firm, it could pay off all its debt and then pay all its free cash flows to the firm back to herself as a dividend. So that's kind of the justification for this model. That it's the possible dividend that someone bought the entire firm and paid off all the debt. So let's look at some simple whimsical cash flow valuation models, and we'll do a little more complicated one. So let's say that based on our model, right, we said that whimsical is going to have free cash flows to the firm next year of $2,028,317. So if I take my $2 million next year of free cash flows, and I assume that that's going to be a no-growth perpetuity, that whimsical is going to pay me $2,028,000 per year starting in 1 year forever, and say I demand a 12% return for that risky series of cash flows, the total value of whimsical, the total value of the assets of whimsical, its ability to generate profits and cash flows, is $16.9 million. The present value of $2 million at 12% forever. If I subtract out the net debt of $2.4 million that we forecasted last time, That would give me an equity value of $14.5 million. If I divide by the number of shares currently outstanding of 1 million, that'll give me a valuation of $14.50 a share. Now the stock's looking like a good buy because it's only selling in the market for $10. Even further, what if that cash flow of 2 million is going to grow at 2% forever? Well, that will give me an enterprise value of 20 million minus my net debt divided by 1 million shares outstanding. I pay $17 a share. So in this case, we can value free cash flows to the firm using a no growth perpetuity or a constant growth perpetuity, and we get 1450 and 1788. But we're going to do one more thing to value whimsical, and that is the only time to use the growth perpetuity, the constant growth perpetuity or no growth perpetuity formula, is for a firm that's already in its mature stage. And I'll define mature stage, and that is growth is going to be less than the growth of the overall economy, say equal to or less than, which is about, say, 3% per year is our nominal growth of our economy. So if you're going to forecast the cash flows will grow at 3% or less per year forever, I would use one of these models. However, if it's going to have a period of abnormal growth, and I define abnormal growth by growth greater than the growth of the economy, if it's going to have abnormal growth, what I'm going to do is do something else. I'm going to actually forecast the periods of abnormal growth. So I'm just going to assume that it's going to grow 4 years. It's going to have a little bit abnormal growth. Look, you see there we have 10%, 8%, 6%, and then it kind of settles into a 2% growth, at least top line growth. I'm then going to use the same assumptions that we did last time. These are all the same assumptions. Lastly, I'm not going to do any forecasts of cash, debt balance, or stock balance. And remember from last lecture, we said that these items actually don't affect free cash flows of the firm anyway, so I don't actually need to plug the balance sheet. If I use these assumptions up top, I then get these free cash flows to the firm: 2 million, 2.3 million, 2.7 million, and 2.8 million. I can then assume that the cash flows grow forever, maybe a constant growth after that, and then I can value the firm. So let's do it. Let's go to our start file. I'm going to go to my final pass. There's my model there. Notice this is what we filled in the first lecture. I just copied the same assumptions for the next few years. I then didn't do anything with the changes in cash, debt, and stock. I then forecast this increases in net income from 2.4 million to 2.7. Notice I didn't have to balance the balance sheet because that has no effect on free cash flow, because all I really care about is this free cash flow estimate of 2 million, 2.3, 2.6, and 2.8. And that's going to be the first place I'm going to start to do my valuation based on free cash flows. So I'm going to say that cash flows start at 2 million, 2.4, 2.6, and 2.8. Then I'm going to assume that they grow at those cash flows. That last cash flow grows at 2% forever, and I want to take the present value, discount it at 12%. So how am I going to value this? So I can take the present value of that $2 million divided by 1 plus the discount rate, 12%. I'm going to anchor that, put dollar signs, and raise that to the n power. So the present value, whoops, I jumped the gun a little bit. Let's actually just put a sum here and say we're going to add up the cash flows. You're going to see we're going to put a value in there in a minute. Then I can take the present value of $2 million, discount it at 12%, anchor it, and raise that to the first power. So I'd pay 1.8 million for the first cash flow, 1.9, 1.8, and 2.8. Or I'm sorry, 1.8. Now here's the problem with this model so far. This assumes that whimsical falls off the face of the earth after year 4 and never generates cash flows again. So how we're going to do it, we're going to put in a terminal value. In other words, we're going to put a value right here, which is the value of all the cash flows from year 5 till infinity, assuming the firm has an ongoing concern and never goes away. So how we're going to do that, we're going to take that last cash flow in year 4, 2.8 million. I'm then going to increase it by multiplying times 1 plus my terminal growth rate of 4%. So now that $2.89 million, that's the cash flow in year 5. All right, that's the cash flow in year 5. I'm then going to divide that by the discount rate minus the perpetual growth rate. Now that's going to give me the value of the infinite cash flow series from year 5 till infinity. But when I do that, it's going to give it to me in year 4. So I then can add up this cash flow, which is the present value of all cash flows from year 5 to infinity, and give me the value in year 4, plus the cash flow in year 4. So I get $31 million. I can then take the present value of that $30 million, and here are the present value of all cash flows. I can sum those up. So here's the present value of all future cash flows. I can subtract off my net debt, which is a little bit above here, my net debt today. So my net debt, I'm going to do minus 3.2 million minus cash of 800. So there's that 2.4 million. I'm going to add that up. That's $23 million. So in other words, the value of the total firm is 25 million, but there's net debt of 2.4 million, and that gives me my equity value. Divide by number of shares outstanding. Currently, which is 1 million, you find that value. I should be willing to pay $23.37 per share. And this is a free cash flow valuation where I've made an assumption that the firm would last forever, so it's an ongoing concern. I had to calculate the value of that future perpetuity, and how I did that. That terminal value is equal to the cash flow in year 4. I grew it by the terminal growth rate of 2%. That gave me the cash flow in year 5. I divide by that cash flow in year 5 divided by the discount rate minus G. That gave me the value of your cash flows in year 5 to infinity, discounted to year 4. I then summed those up, took the present value of all free cash flows, and that tells me my total enterprise value. Subtract out my debt. There's my equity value. Divide that by number of shares, and there's my equity value per share. And if the stock is trading for $10, it's looking like a great buy. Now, there's one other way of handling this terminal value, and it's probably the more common way. That more common way is to do this. Calculate the terminal value by not using a growth perpetuity. What we're going to do is we're going to assume that in year 4, the firm has a valuation of some multiple of EBITDA. All right, so this is a very common way that investment bankers will value firms. And what they'll do is they'll find that, say, the average mature firm in my industry sells for the total enterprise value of that firm is about 5 times EBITDA. Now that number 5, I just made that up. Normally that number is probably more like between 5 and 10. So if I take my EBITDA multiple, I have my same cash flows here. I'm going to say at the end of year 4, I'm going to receive that final cash flow. And then if I had to, I could sell the firm for 5 times year 5 EBITDA. So I need to go up there and find EBITDA. There's my EBITDA. So 5 times year 5 EBITDA is 32,111. I can then take the present value of all future cash flows, 27 million, subtract out my net debt. All right, do the same thing here, divide by number of shares. So these are the 2 ways of handling ongoing concerns. In other words, 2 ways of coming up with the terminal value. I can either take a growth perpetuity, or I can use, say, a cash flow multiple or an EBITDA multiple. Sometimes people could do a sales multiple. You know, how many times sales do firms sell for? So these are my valuations. So let's go back to our presentation. We We calculated our present value perpetuity of cash flows. We then did our EBITDA multiple valuation of cash flows. And the last thing we're going to do before we go a little bit of VBA is I'm going to do a data table. In other words, how do I do sensitivity analysis around this final valuation? We'll do the final valuation of the EBITDA multiple valuation. So let's go back. We're going to set up something called a data table. All right, I have it set up here. Notice these are just formats. All right, there's nothing special here. I just wrote discount rates and EBITDA. And what we're going to do, we're going to do a sensitivity analysis. What if my discount rate is 8, 12, 16, or 20%? And what if my EBITDA multiple is 3, 5, 7, or 9? In other words, let's do sensitivity analysis. What if this EBITDA multiple right here is different, and what if the discount rate is different? So what we're going to do is, the first thing I need to do is whatever I want to do a sensitivity of, I just do a link right here. So I'm going to do a link to this 2540. And then I'm going to highlight this entire table and hit Data, What If, Data Table. It asks me, well, where's the original cell for your row sensitivity? So my row are discount rates. Those discount rates were input right here. Here's the original source of the discount rate. And then what column? That's the EBITDA multiple. Where's the original source of that EBITDA multiple? And it's right here, the 5. I'll hit OK. And notice I now have created 4 by 4, 16 possible valuations. Here's our base case valuation when we think the discount rate is 12%. And we think the EBITDA multiple is 5. And then we can get a sensitivity analysis. These are all equity valuations. So in other words, if I plugged in 8% and 5 and 3 as an EBITDA multiple, I would have a valuation of 1986. So this is how you'd use a data table to do a sensitivity analysis. So now let's just take a little bit of a bonus lecture, and that is let's learn what VBA is and how to write a function. So let's go back to our presentation. Now, a couple things I want to say before I finish, and that is our fundamental valuation using the multiple is $25. Remember, our stock price was $10, so it looks like a really good buy. In other words, if the discount rate is 12%, we're going to earn more than a 12% return if we buy the stock at $10. Actually, if we bought the stock at $25.40 and got all the expected cash flows we forecasted, we would earn exactly 12%. So the fact that we can buy this stock for $10 tells me that I'm going to have greater than a 12% return. And actually, we can calculate what the return of this stock is by doing something called a goal seek. So I'm going to go back to my spreadsheet, and I'm going to say, what discount rate would I need to get this valuation? We'll just look at this one right here to be $10. Well, what if I change it to 20% or 30% or 40%? Oh, at 40%, it's about a $10 stock. So it looks like the stock is giving me about a 40% return. But I can get the exact value. So what I can do is do data, what if, goal seek. And it says set cell. I want to set this to $10 by changing the discount rate. And when I do that, I get 41%. At 41%, this stock is fairly priced. In other words, at a $10 return, a $10 stock price, the only discount rate that makes the valuation also $10 is 41%. So I must be getting a 41% return. Just talk a minute about market efficiency. And so in this model, it looks like we found a really great stock, one that's selling for $10, and which if we bought it now will give us a 40% return, or another way of thinking about it, it's a stock that's worth $25. However, there's a lot of evidence that says that the average person can't find undervalued stocks like that the market is very efficient, and therefore the average investor is not going to find these undervalued stocks, and what's probably more likely is our model's flawed. So if you want a discussion of market efficiency and what that implies for stock picking, you can take a look at chapter 14. Lastly, I want to just show a shortcut way of some kind of a quick and dirty valuation. So some company XYZ, you just calculate it, they're going to pay $3 next year per share in free cash flow. I'm sorry, I shouldn't say pay. They're going to earn free cash flows per share of $3 per share per next year. And then you forecast that those free cash flows are going to grow at 20%. So I'll take my 3 times 1.2. Then they're going to grow at 10%. So I'll take my 3 times 1.2, which is my year 2 cash flow. Increase that by 10%. I get my year 3 cash flow. So this is the cash flow in year 1, 2, 3. And then I'll make the assumption that cash flows grow at 3% forever after year 3. So what I'll do is I'll take my year 1 cash flow, my growth rate in year 2, growth rate in year 3, growth rate in year 4. Now that cash flow is going to grow at 3% forever. So this numerator here is the cash flow in year 4. I'll divide by K minus G, my discount rate minus the growth rate. That'll give me the value of all those cash flows in year 3. I'll discount all of those cash flows at the discount rate of 10% for 3 years. Discount my year 2 cash flow at 2 years and year 3 cash flow at 1 year. And that valuation will be what I would pay today for this stock that's going to pay, has a free cash flow of $3 next year and then grows at 20, 10, and 3% forever. So in this topic, we talked about the concept of time value of money. We computed the value of a lump sum, an annuity, and a perpetuity. We computed enterprise value and equity value using cash flow valuation models. And we created a 2-factor data table and also used Solver. Now, what we're also going to do now is create a VBA function. So here's our VBA bonus lecture, creating VBA functions. VBA, Visual Basic for Applications, is a programming language used in MS Office. VBA programs are called functions and are saved in macro-enabled worksheets. A VBA function can be used in a worksheet by inserting a user-defined function, almost like how we insert the PV function. So we're going to create a user-defined function. It's not going to be CAPM. We're going to actually call it PVGP. We're going to create a function called PVGP, Present Value Growth Perpetuity. All right, so here's how we're going to do it. We're going to go to Excel. And let me just open up a new worksheet here. I just clicked on Add. And say we're going to calculate the present value of a growth perpetuity. So we say, what if we say the cash flow is $100? The discount rate is, we'll say 12%, and the infinite growth rate, I should write 12% there. The infinite growth rate is 2%. All right, those are my inputs. And we're going to calculate present value growth perpetuity. And that's going to be my cash flow divided by R minus G, or K minus G. There's my $1,000. However, we're going to write a function that could do this for us. Now, all functions are stored in VBA. So how we're going to do there, we can either go to Developer tab. If you don't have the Developer tab, follow the directions to go to add the Developer tab. However, you can bypass that. Now, for me, I can do Developer tab and hit Visual Basic. That's where we're going to go. Or you can just go from Excel and just hit Alt F11. And I'm in this Microsoft Visual Basic for Applications. Once I'm here, I'm going to do something called Insert a Module. Not a class module, a module. And this is where we write VBA functions. How we write VBA functions is we write the word function. We put a space and just give it a name. We're going to call this PVGP. Do a little space, open paren, and let's put in the inputs or parameters. R, G, and cash flow. Now I'm going to hit enter. Notice this function turned blue. The word end function came up. That's the closing line of every VBA function. And then here I need to write in the name of my, or put in the program lines. So what we're going to say is PVGP is equal to cash flow divided by R minus G. So I've written my first function. PVGP with parameters R, G, and CF. PVGP is equal to cash flow over R minus G. N function has already been inserted for me. I'm going to close that, and I can just put in the function right here. So I can click on this cell right here, click on my function wizard there, insert function. I'm going to ask for user-defined functions. I'm going to then click down here and search for PVGP. There it is. There's my R, there's my G, and there's my cash flow, and there's my $100. So that is writing your first function. All right, so there's my first function. Notice it doesn't show up if I just equal PVGP. I'm going to have to insert it like I did here using the insert function or going to insert function. So let's go back to the presentation. Every function starts with the word function. You give it a name, put in the inputs parameters, write in your program lines, and end function. I'm going to add a few things here, and that is, let me go back to my program. I'm going to add in some descriptions. And in VBA, anytime, I'm going to go back Alt F11, anytime you put in a program line, I'm just going to insert a line right there by hitting enter and put a single quote and say PVGP computes the value of, I just say the present value of a no growth perpetuity. Notice it turns green. Now I could also put this little code right here to the right. I could make a description, maybe that R is the annual discount rate. All right, so notice anytime you use a single quote, it turns green here, and VBA ignores those statements to the right of the single quote. I'm going to close that. A couple things why I'm here. This is called our Project Explorer. I'm going to make sure that whenever I have a function, I want to make sure I only have one module. I'm sorry, if I have here's my workbook here, Lecture 2 worksheet, start file. There's the module I input, and there's the function I wrote. I want to make sure I don't insert module every time I come back here. I just want to use module 1 because it'll allow me to insert more modules when I don't do that. A couple things, if you were to make a mistake, the only thing I'm going to generally use right here is this little thing where it says reset. So if I somehow mess this up and maybe I took the word function out there, I'm going to have a mistake there. What I do is I'm going to hit reset, put in my F, and then I'm okay. Also, whenever you save a worksheet that has a VBA program, you have to do File. Well, I'm going to get out of here. I'm sorry. Let's get out of here. When I go ahead and save this file, File, Save As, you must save it as a macro-enabled workbook. If I were to save this as just a workbook, I would lose my VBA, would actually delete off the modules. So make sure you save all your worksheets as a macro-enabled workbook. So that's the basics of VBA programming. Make sure you only insert one module in each worksheet. This program we wrote, that module and this program we wrote, PVGP, it's only good for that worksheet. So you're not going to find it if we insert it in another worksheet. And make sure you save it as a macro-enabled workbook. Another important, probably one of the more important functions you can do in VBA is we can put code that uses if statements. Now, in VBA, if I want to do an if statement, I have to say if some condition is true, then. So we're going to talk about these if statements. They must follow this logic or format. You say if something's true, then some calculation, else if some other condition, then, and you can continue that till you're done, do your last else statement and end if. So here's a real simple program. We're going to say the word function, We'll give it the program called letter grade, and it has one parameter, one input, and that's percent grade. And what I'm going to say is if percent grade, in other words, that input is greater than 90%, then letter grade equals A. Else if percent grade is greater than 80, then letter grade equals B. Else letter grade equals C. End if, end function. To take my function, actually I'm going to save ourselves a lot of work. I'm going to copy it right from here. Copy. I'm going to go to my workbook. I'm going to do Alt F11. I'm just going to paste it down here. And notice you have one module can have many functions. I have function letter grade, parameter percent grade, and there's my function. I'm going to close that. And let's go ahead and do percent. We'll say percent equals 90%. And let's calculate letter grade. I'm going to do an insert function, user defined. I'm going to click down here, type in letter grade. I'm going to find it. And it only has one parameter, percent grade. And there's my B. So my parameter here is percent grade. And my solution is letter grade. And notice if I make that, say, 99%, there's an A, 85%, there's a B, 60%, there's a C. So that's the basics of VBA programming.